and hello to all the viewers and listeners of this edition of Fixed Income Markets with Sundaram Mutual Fund. In many economies facing growth headwinds and price pressure, the central bankers have decided to moderate the rate of pace hikes in favor of the argument that growth is slowing down and monetary actions works with a lag. Australia opted for a smaller 25 basis point, while Federal Reserve is likely to moderate the pace of hikes in its upcoming meet on 14th of December. Canada also opted for a 50 basis point hike in its latest policy, lesser than the 100 basis points in a prior meet. In a prelude to this monetary policy in India, we have seen the descent in the MPC minutes between members on count of the quantum of rate hikes and the stance of policy. Taking a cue from all this, the MPC delivered a 35 basis point hike in repo rate, taking the repo rate to 6.25% and consequently the standing deposit facility rate to 6%, while marginal standing facility rate to 6.5%, and retaining the stance of withdrawal of accommodation. The quantum of hike was on expected lines, while the market was anticipating a change in stance to neutral to indicate the nearing of rate hike cycle to end and signal a pause. This was construed as hawkish by the market as it retains the option with MPC to hike further, and yields have risen by 5 to 6 basis points on various liquid G-Secs. Governor in his statement alluded to the persistence of inflationary pressures as the reason not to be complacent on fight against inflation as yet and highlighted the Indian economy resilience against the global backdrop of diminishing growth. Globally, the word recession has rooted the literature abound on all platforms, right away from print, electronic, and social media. One thing is sure, everybody on the street is prepared for a recession, which means a muted response by markets if we see recession hitting the globe, as it is discounted in the prices. What is now evident is that the global economies, particularly the larger ones, are bracing themselves for a slowdown, and some, like China, after unprecedented protests on COVID lockdown, has seen a resolve from the Communist Party to not only open up but pursue a growth agenda for the economy. This augurs well for the supply side inflation, as still a large part of supply chain is located in China and will take multiple years to diversify to other countries. On demand side, we will likely not see a heightened risk on account of higher rates feeding into the larger economies, forestalling any aggressive consumption up move. Domestically, India was facing inflationary pressures, although be it milder than developed markets on account of food prices and raw material prices for producers, which had started feeding into the retail prices. But the international commodity prices have weakened in the last quarter and continue to soften. Also, the Rabi sowing has been robust and higher by about almost over 6% from the last year with good soil moisture and multi-year high reservoir levels. This augurs well for winter crop, resulting in stemming any runaway prices. Caveat to this is any surprise on the weather front or further geopolitical escalations resulting in international commodity price rise. In this backdrop, an eye on the developed market central bankers for further action on their policy rates, India can look to chalk out a growth path amid uncertain times. The growth momentum in India continues to be good, as evidenced by major high-frequency indicators like tax collections, manufacturing and services PMI, passenger vehicle sales, tractor sales pickup, two-wheeler sales pickup, etc. The and if we now pay our attention towards the curve continues to remain flatter than the earlier times, and investors are recommended to consult their advisors and, depending on their investment horizon and risk appetite, form an investment strategy on the fixed income. As in earlier episodes, we continue to recommend short-term investors up to 3 months investment horizon to use short duration buckets like overnight, liquid, ultra, and money market to manage their cash flows, while clients with longer investment horizons of 9 to 12 months can use active duration strategies in low duration and short term fund, short duration funds. For passive investors of over 36 months investment horizon, target maturity funds offer a compelling proposition from both return and quality perspective. Happy investing and season's greetings to all of our listeners. See you all in 2023. Thanks a lot.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.